This model only has one tab. Right? You're probably rejoicing about that. Right? So everything is contained on one tab. Like I said before, it's a pretty straightforward, simple model to put together. And we'll walk through that, walk through the model. First thing we're going to need to input are the buyer and seller names. All right, so who's the acquirer, who's the target? When we enter those names in the model, you'll see that anywhere it says acquirer-input, targets-input, the dash input portion of that will change to reflect whatever names we enter there. All right, so we'll see that in a little while. What is the transaction date? Obviously very important. You'll see that transaction date here is the same as the date on which we spread all of our companies before, December 19th. Right. The reason I chose this is it will allow us to use a lot of the information we already have in our valuation model. Okay, if we hadn't already spread these companies, that'd be the first step here. Spread Kraft, spread Kellogg, so we can get a sense for all of these items that are down below. What are their share counts on a fully diluted basis? All right, again, you'll see these hard-coded in the model because we're just taking it from another model. We've already done that work. What are their share prices as of that transaction date? What is the target share price offer? In other words, what is the buyer offering to pay for the equity of the seller? And once we enter that, we can calculate a premium. So what is the difference between the offer price and the current share price? What is the implied value of the target? Implied value of the equity based on that share price, that offer price? What is the implied enterprise value based on that? So we'll calculate those as well. And then we'll talk about what is the consideration of the deal. How much cash, how much stock? Sometimes a deal can be 100% cash, sometimes a deal can be 100% stock, sometimes it can be a combination of the two. And this model allows for any of those three circumstances. If we enter in the cash component as a percentage, we can calculate what is the share component. We can calculate that on a per share basis, and also calculate that in total, as we'll see when we get into our model. Next item, what is the source of the cash component? So are we pulling cash off the buyer's balance sheet, or are we borrowing, like we said before? And then what is the interest rate associated with both? Remember, if we use balance sheet cash, there's a cost to that as well. It's lost interest income, so we need to be able to calculate that. So we need to know the interest rate earned on cash. We also need, obviously, the interest rate that the company would pay on any new debt. Okay, if it's a stock deal, we'll calculate how many shares are issued, how many shares of the buyer get issued to the seller to finance the deal. We'll also calculate that exchange ratio that I mentioned before. All right. And then once we have all of the information we've just gone through, we can calculate pro forma ownership. That is, how much of the combined company is owned by the buyer shareholders, how much is owned by the seller shareholders. This will be a stock deal, so it'll be a combination of both. Buyer shareholders will have some ownership, the sellers will have some ownership. At the end of the day, the buyer shareholders will own a majority of the combined company, which is pretty typical. All right, we've got a section to input what do we expect pre-tax annual synergies to be if we're working with a buyer, or maybe if we're working with the seller and we have an idea of what those are. This is where we would input that in dollars. So 100 million, 200 million, what have you. Typically a lot more work goes into that than just pulling a number out of the air. All right, but we would, at any rate, we'd want to enter that in. Also be able to calculate that on an after-tax basis, and I'll show you where that links into the model in a little while. And then this section here where everything is highlighted in yellow, this is where pre-tax synergies required to break even are. We talked about that before. Once the model is done, those values will calculate for us. Okay, down below, we've got what we're calling a multiples analysis. All right, so we're going to calculate some valuation multiples associated with the buyer, associated with the seller, and associated with the pro forma combined company. And so what does the buyer look like? What's its price earnings multiple? What's its total enterprise value to revenue multiple. What's its total enterprise value to EBITDA multiple? Same thing for the seller, and then same thing for the combined company. So we basically need to capture all of those items that we need to calculate enterprise value, and then we'll have revenues, EBITDA, EBIT, net income pulling from somewhere else in the model. It's a pretty straightforward analysis. It really is. And just like anything else, most banks will have a template for this. If you really just follow the template, it's kind of hard to make a mistake. We'll get through this in probably no more than an hour. Right. If we scroll up and to the right, again, on the same tab, there's only one tab in this model. We've got earnings per share, both on an LTM basis and a forward basis for both companies, buyer and seller. These numbers, you'll see that they're hard-coded. We've pulled those from the valuation model, basically the numbers that those analyst reports gave us. So those Credit Suisse reports told us what those EPS forecasts were going to be. The LTM EPS we calculated based on what our spread indicated. So those are pretty straightforward. We can use those combined with a share price for each company to calculate PE ratios. So what is the PE ratio of the buyer? What is the PE ratio of the seller? All right, based on their current share price and also based on their based on the offer price for the shares. So we'll do that. And then as we scroll down, we're actually putting together a shortcut income statement, if you will, a summary income statement. What were the buyer's revenues on an LTM basis, on a forward basis? Same for the seller. What do we expect the combined company to look like, top line? Do the same thing for EBITDA. Right, again, EBITDA being a proxy for cash flow. Do the same thing for net income. But when we talk about net income here, we're talking about before we take into account any effects of the transaction. Right? Anything that can be dilutive or even possibly accretive. All right, so before we take into account synergies, before we take into account amortization of any intangibles that arise from the deal, before we take into account any lost interest income or additional interest expense. So what we're doing is taking that unadjusted net income, we adjust it for those items that can be either accretive or dilutive, and that gets us to pro forma net income. What does the income of the company look like on a combined basis after we account for all those accretive and dilutive items? And if we divide that by pro forma shares outstanding of the combined company, it'll give us pro forma EPS. Once we have pro forma EPS, we compare that to the EPS of the buyer prior to the transaction, and it tells us, is the deal accretive or dilutive? Right. Might sound like a lot, might seem like a lot of steps, but again, this is a pretty straightforward analysis. I think once you get into it, you'll see that as well. All right, let's go back to the slides quickly. What I want to do is review a couple more of these slides. We'll talk a little bit more about the Kraft-Kellogg transaction in a moment. All right, and actually here on slide 13, where we've got some assumptions around a potential transaction, these are actually assumptions you're going to use in your homework. All right, so this is going to be part of your homework exercise. The buyer, it's a hypothetical buyer, hypothetical seller. We didn't even get too creative in naming them Company A or Company B. It's just acquirer and target. Okay, buyer's going to buy seller for $18 a share, which is 100% or a 20% premium to their current share price. They'll finance it 50-50 cash and stock. That exchange ratio will end up being 0.31x, which is another way of saying for every share of the target that's getting purchased, the buyer is going to issue 0.31 shares of its own stock as currency, as consideration for that, plus $9 in cash. And that cash portion will be financed with debt. They'll draw on their revolver to finance it. And the buyer is also going to assume all the target's outstanding debt and liabilities. These are just a few of the assumptions you'll use in your homework. The rest of the assumptions in your homework are in the homework folder in the accretion dilution instructions file. All right. But that's just some of the assumptions that you'll be using. All right, and again, the goal is to build a shortcut accretion dilution model. Basically, as I just talked through, the instructions will teach you how to input the fully diluted shares, current share prices, calculate the offer price, calculate the premium. It'll give you projected revenues, EBITDA, income, earnings per share, all those items. It'll give you a tax rate. So all those other assumptions will be included in that file. And then here's a step-by-step. All right, I'm not going to read through these, just like all of our other models. Until we actually do one, these step-by-step approaches aren't going to make a lot of sense right now. But if you ever need to go back for reference, it's on page 6. It starts on slide 16 and goes for a few slides. And also tells you how to calculate those sensitivity tables. All right, but let's talk about the example we're going to do in class. Again, this is a hypothetical deal, Kraft buying Kellogg. In this case, we're assuming Kraft is buying Kellogg, buying 100% of the company for $48 a share, which ends up representing about a 13% premium to Kellogg's current share price. This transaction, the $48 per share amount will be financed $9.60 in cash. So every share will get $9.60 in cash. Each share will also get 1.44 shares of Kraft stock as consideration for the deal. Okay, that cash purchase price, cash portion of the purchase price will be financed through borrowing. Kraft will borrow under its revolver. They pay 6% on their debt. They earn 4% on their cash. And Kraft will also assume all of Kellogg's outstanding debt and all of their liabilities. Okay, so when we calculate the combined balance sheet, we not only want to take into account the new borrowing here, we also want to take into account Kellogg's debt that gets assumed in connection with the deal. Make sense? Okay, let's go back into our template and we can start actually building the model. Just like every other model, it's always a good idea to run in manual mode. All right, so you probably just want to make sure you're set up to run manual calc. All right, so the first step here, enter the buyer and seller names. So the buyer, again, is Kraft. Seller is Kellogg. You could enter ticker symbols too. Really just kind of depends what your preference is. All right, I just entered the full names. And when you hit F9 to recalc, you'll see that every place it said acquire-input or target-input, now instead of input, it has the buyer and seller names. And if you want, you can look at that formula where it's basically adding some pre-populated text to the text that appears in these cells. Just kind of a nice piece of Excel functionality. Elegant way to link that up. Again, transaction date, December 19th, 08. We've got their share counts, we've got their share prices. Again, those came from our spreads. And if we did not already have these companies spread, you'd have to do that. You'd probably spend a few more hours doing that. So that can be a little time consuming, as we know. Next thing we need to do, enter the share price, the target offer price for Kellogg, which we said was what? $48. We'll enter 48. And now that we have that, we can calculate our premium. The way we calculate that is we say equals, in this case, B19, or that target share price offer, divided by their share price immediately before the deal, or B16. So B19 divided by B16 minus 1. It's the same formula we use for a one-period growth rate. So it should look familiar. And just like we said when we talked about the assumptions, it ends up being about a 13% premium. Pretty consistent, if you recall, back to our precedent transactions approach. When we looked at all those different deals, 13% was kind of right in the middle there. All right, so pretty representative of this industry based on historical deals. All right, now based on this, we can calculate the target, the value of the equity for Kellogg based on the offer. And how would we do this? Yeah, offer price times shares outstanding. Okay, so we'll take that $48 a share, we'll multiply it by 381.7 million shares outstanding, okay, or equals B19 times B12, implies a value of the equity of $18.3 billion. Another way of saying that is the market value of equity, the MVE of the deal, is $18.3 billion. So that's the equity value. We also want the enterprise value of the deal, right? Because if we're going to calculate enterprise value multiples, we need to have total enterprise value. Okay, and actually, instead of calculating it right here, what we're going to do is we're going to link down to our multiple analysis section. We can link to cell E66. Actually, before you do that, hit F9 to recalc. Now we can link down to cell E66, where it's calculated for us, 23.2 billion. So what this multiples analysis section does is it takes that 18.3 billion market value of equity we calculated a moment ago. We're adding debt, we're adding preferred, we're adding minority interest, and we're taking out cash. Just like we know how to do, just like we've always done, calculating enterprise value. We're just doing it in a separate cell here. All right, so the equity value of the deal, 18.3 billion. Enterprise value or transaction value, 23.2 billion. Next thing we want to do is we want to start analyzing the consideration for the deal. In my lecture slides, we talked about the deal having a cash component equal to $9.60 a share. As a percentage of the total, it ends up being 20%. Right, so where it says input for the cash component, we're going to input 20%. And when you hit F9 to recalc, all of these other cells in this area should recalculate for you. First of all, the acquirer's shares issued as a percent of the total deal. It's just going to be 1 minus the cash component. And if we pay 20% in cash, obviously the remainder has to be paid in stock. So that's 80%. If it was a 50-50 deal, you input 50 for cash, hit F9 to recalc, and everything calculates for you there as well. All right, so the way we've set it up is so that we can sensitize on that. We can change that cash component of the deal anytime we want to or need to. All right, if we multiply both of those by the offer price, it'll give us the implied price per share for both the cash and the stock consideration. So just like we said in the assumptions, Kellogg is going to get, their shareholders are going to get $9.60 in cash per share, plus some shares of Kraft. All right, and those shares end up being worth $38.40 a share, because the two have to add up to 48. That's the offer price. We're just splitting it among cash and shares. And then we also look at it on an aggregate basis. So that 18.3 billion market value of equity breaks down to being 3.7 billion of cash, 14.7 billion of stock. Makes sense. All right, so let's look at the cash component here. Let's set this up. Remember how we said they were going to finance this? Kraft was going to finance the cash portion of the deal by borrowing. That is, they're going to use no balance sheet cash. All right, so what I'm going to enter here for cash on balance sheet, I'm going to enter 0. Remember the interest rate I earn on my cash was 4%, so we'll enter 4 there. Now what would be the right way, now that we get to the debt line, what would be the right way to calculate how much debt Kraft is going to issue here? Or how much they're going to borrow to fund the cash portion? No, not 20. Oh, wait, did you say what?
Cash component 20%.
Well, no, this is how they're going to fund the cash.